Okay. Hi, this is Troy Patton. Welcome to the 2015 Mid-Year Update and Outlook. I wanted to jump into things real quickly here. I know we're just after the start of the month in July, and I wanted to get everyone up to date on where Archer Investment Corporation sees the market and where we think it's headed, and give everyone kind of our mid-year update and outlook. So if you will, if you're following along with the slides online, that's great. Obviously, we're going to talk about a few things. And, so far, this year, the market really through June 30th has really risen just a simple 1.2%. Years ago, that was probably even less than the dividends that used to be paid on the S&P 500 stocks. There's a lot of worries in today's market with Greece, Puerto Rico, China, and the so-called Grexit, and nobody really knows what's going to happen there, although we all presume that they'll try to figure something out to keep Greece in the Eurozone, so to speak. And obviously, at the start of the year of 2015, when we put out our annual update and outlook, we expected returns somewhere around the 6% level. And we still see that as a very high possibility. Obviously, returns could be somewhere between 6 to 8%. Obviously, no one really knows, and anyone that lives and dies by a crystal ball probably ends up chewing a little bit of glass. But with that being said, I want to point out a couple things why I don't think this recent market volatility is all that much to be alarmed about. I really don't. I mean, obviously things could change at any moment, but at this point in time, if we go back and look at what's called the VIX, or Volatility Index, and it's basically where people buy insurance against the stock market. The VIX rises as people get nervous about the stock market, and the VIX lowers when people are a little bit less nervous. And right here you can see these three red circles, and the farthest red circle on the right is really where we're at right now. It really doesn't appear that the VIX is spiking. So even though people are saying they're worried about the market, it doesn't even rise to the level of what we saw in the December 2014 time period, or even the peak in October 2014. December, January, people were worried about the market declining right away. It hasn't even risen to that level. With that being said, just to talk just briefly about Greece, I mean, as we all know, Greece is its own country, but it has roughly the GDP of Rhode Island. If anyone recalls, back in 2001, Argentina went bankrupt. Argentina was about 3 times the size of Greece and really had no impact on the world markets. I really don't see much coming from this Greece fiasco as well. I think probably more importantly is even China. But as of this morning, China reported growth of 7% in their markets. Yes, it's not the 10, 12, 14%, but 7% is still pretty decent. Okay, so I don't think there's a lot to really worry about there. This next chart really just shows that there are going to be ups and downs in the market. Oftentimes, what this is the red numbers, or the numbers below, really show the decline in the market from a peak to a trough at any given time during the market. So obviously, even though the market does decline from time to time by certain amounts, I mean, as you can see, 19%, 4, 6, 8, 15, 17, et cetera, even some in the 20s and 30s, it doesn't mean that the market is going to be negative for the year. In fact, the market, through its normal course of gyrations, goes up and down all the time. And so there really is no need to panic, even though the market has dropped, 4 or 5% here or at one point. Frankly, I'd be surprised if it didn't drop more. I think we've gotten a little complacent here over the last couple of years with the market dropping in the single digits. It's been some time since we've had a 10% drop in the market, and quite frankly, one would not scare me even the least bit. And part of the reason I'm saying that, and I think there is a lot of health in the markets, albeit, again, we're looking at a 6 to 8% return, at least that's what we expect, is if you take a look at these next charts, corporate cash as a percent of current assets S&P 500 companies has continued to increase and escalate. If you go back and look at all the way from back to 2000, it's literally it's more than doubled since that time. These are cash and cash equivalents, and then the next little slide over down and to the right is cash return to shareholders. We're continuing to see higher dividends, higher share buybacks. A lot of these companies have so much excess cash that they're returning it to the shareholders. And I think that's really important because actions usually speak a lot louder than words. Anybody can get on TV and say, all kinds of crazy things, but if their actions are proving them otherwise, then I would say that the market still has some room to run here. The next slide is something that we've talked about many times in the past, and even though this is an older slide, I still think it's very important. And it's called the Great Share Shrinkage. Frankly, because of the buybacks and buyouts of different corporations, they're becoming less and less net issuance of corporate equities. So that basically there's less shares to buy. It's a supply and demand thing. I really think it's going to continue to push the markets higher over time, and I have no doubt that these share buybacks and dividends that these companies are creating are here to stay. It would be very odd for some of these companies, as we've seen them raising maybe their dividend rates of somewhere between 6 to 10%. And for instance, Disney is now going to pay their dividend a little bit different and actually increase their dividend. It'd be odd for them to take that dividend up, and then all of a sudden the board would all of a sudden decide in the next quarter or two to relinquish or have a decline in those dividends. That would not sit well with investors and actually create some pretty big havoc probably on the board, and therefore I really don't think that we're going to see a relinquishing of those dividends. It also means that the boardroom is very optimistic. If they're optimistic about their company, they're optimistic about the outlook of the economy, and so on. Otherwise, they wouldn't be raising those dividends. The next slide here is we haven't seen it yet, but I really think that we're going to get a little better consumer spending. Even though we just saw month-over-month retail sales decline here recently, I really think that these lower oil prices and this lack of inflation, so to speak, is really going to put more money in the wallets of every household. And we've seen this. The household debt service ratio has continued to decline through the first quarter of 2015. You can see it's almost similar or even less than it was back in 1980 when interest rates were really high. And then household net worth continues to climb as well. So I think these are all favorable items for the consumer out there. I think these are all favorable items for the U.S. economy. Okay, let's talk about the inevitable rate hike that's going to happen at some point in time. As we look at the next couple of slides here, we know the Fed is going to raise rates at some point in time. It's just a matter of when. It's not if, it's when. We've already seen the 10-year Treasury interest rates start to increase, hovering somewhere near 2.3 to 2.4%. I really see those continuing to move a little bit higher. The one problem the Fed really has is it's never a good time to raise rates. It just never is. Unless they're forced to do so, there's always some excuse that they're going to have why they don't want to raise rates. The other problem is right now, by some accounts, our government or the Fed has already been tightening our currency. The U.S. dollar has risen, as most of you know, and part of that is because we have ended our quantitative easing while Europe has just begun their quantitative easing. So as they continue their QE, we've ended ours. It's created more liquidity of their currency and less of ours. Therefore, our dollar has risen. Quite frankly, with all the currency that we printed over the years, I do believe the dollar is overvalued, but then again, we're the best of all the worst. So, raising rates at this point will only make the dollar stronger and will reduce our exports to other countries, which will hurt our manufacturing sector at some point. I still think our U.S. consumer is going to do well because the dollar is strong. We can buy more goods, truthfully, for less. So there'll be more people importing into the United States, and the U.S. consumer will benefit, but then at the same time, our exports probably are going to become a bit more expensive, okay? If you look at these charts here, the one on the left is really, it's the performance around the first rate hike, and this is the S&P 500. And we can see kind of where we are currently. It's the light gray line. The dark blue line is really the performance of the S&P even after the first rate hike. And as you can see, initially there is a decline, but then it starts to edge up over time. And likewise, the chart on the right is our international. Typically international declines. And that's because we're tightening our monetary policy, and usually they're tightening their monetary policy also. I really think we're going to see more of a muted line, in fact, more of a flat line for both. And part of that is because, again, like I said, the Eurozone they're embarking on their own QE. We have ended ours. I think that it will raise our interest rates somewhat. However, I think it's going to make the dollar stronger, which in turn is going to hurt profits of foreign or U.S. companies operating in foreign territory, which, quite frankly, many of them do these days. In fact, many companies, 50% of their revenues come from overseas. So in the past, these tightening cycles, we've always outperformed our overseas competition. But again, I think this time might just be a little bit different. I think we're going to see more of some muted increases in the S&P 500 over the next several years. Okay. Well, that brings me to the next chart that we have, and I always like this chart because a lot of times people are always asking different questions. Gosh, I hate to get into the market. I'm waiting for it to decline, and one of the things I always tell people all the time is I always say, is the market higher than it was 3 years ago, 5 years ago, and 10 years ago? And the answer is yes. And obviously the answer is not always yes. In 2008 and 2009, the first couple of those was probably no. But then, let's look out 3 to 5 and 10 years, 3, 5, and 10 years from now. Is the market going to be higher? In 3 years, yes. 5 years, yes. 10 years, yes. I mean, obviously there are our opinions, but I do think the market will continue to move higher. The U.S. economy is very resilient. We are still, the majority of the major companies are still being born here in the United States. We're still innovating. The manufacturing sector has seen somewhat of a rebound, in our opinion, and I really think the U.S. economy is a great place to be. I think there's some really good opportunities in oil services right now. Some of the oil companies are looking very attractive with their dividends, so you're going to be paid while you wait for the stocks to recover, and we've seen that happen time and time again as well. So again, we're continuing to look for opportunities, and as this slide shows here, there's once a study called, and it's done every year, it's the quantitative analysis of investor behavior. And really is what this chart shows is that it really is, investing is much more about time in the market than it is timing the market. So, if you were to invest $10,000 and you missed out on just a couple of days, you can see here that, you would have had muted returns. In the last 12 months, the average equity fund investor at the end of 2014 returned 5.5% according to this study, this Dalbar study. The S&P returned 13.69. Okay, the Barclays Aggregate Bond Index returned 5.97. Again, people guess wrong the majority of they know the direction. In 8 of the 12 months in 2014, they were right about the direction of market. But what they weren't right with is how they put their money to work when it actually came time to buy and sell. So it's always important to have a plan in place, okay? Overcome some of the common misconceptions. The market's too volatile. I'm going to sit on the sidelines for a bit so I don't lose money. Trying to be right twice, selling at the high, buying at the low, or buying at the low, selling at the high. I'm not saying you may not get it right once, but getting it right twice is very, very difficult. Even the experts don't do that. I mean, if that was the case, everybody'd be sipping Mai Tais on some beach somewhere, okay? Sitting out can really cause you to miss out on potential market rallies. The majority of market rallies come right after market declines within the next week or few weeks, so you got to be careful there. And then the next one, I should invest conservatively so I don't run the risk of losing my retirement assets. Again, retirement age investors have potentially long time horizons. This is what I tell people all the time is, hey, when you turn 65 and you decide to retire, you're probably not going to pull all your money out on that day. No, you're going to live for a long time, and you're going to need those dollars. So you want to have a good diversified portfolio of stocks and bonds over a long period of time. It's not always chasing the returns of the S&P 500. Maybe you don't want that risk because you want a little more slow and steady, the tortoise and the hare type thing. But anyways, with that being said, I'd just like to kind of wrap up the presentation. This is our mid-year update and outlook. Again, we post these every once in a while. We print them twice a year all the time, and occasionally we record these. If you do have any questions, please consult your investment advisor, and I'm sure they'd be more than happy to help you out with anything that you might need. With that being said, thank you very much. Again, this is Troy Patton with Archer Investment Corporation, and we look forward to some happy investing for everyone. Thank you.